So it was our first IPO of 4 crore rupees in 1994, and that was the time Harshad Mehta hit. It was a very, very tough IPO for us. If somebody invested with us in 94 in our IPO, that was a 10 rupee share, and we offered this for buyback in 2014 at 456 rupees. So that's 45x.
Let's just say that this was one of the biggest exits in packaging at that time, running into hundreds of crores.
Today on the Create Wealth podcast, meet Rajat and Ankit Kedia, the second generation leaders of the Manjushree Group. Manjushree's journey to becoming India's packaging giant has been fascinating. The company went public in '94, took the bold decision to delist, raise private equity capital, and eventually sold in one of the biggest acquisitions in its space. Now, Rajat and Ankit drive change through the family office, Manjushree Ventures, their venture capital firm, Capital A, and multiple operating businesses. Let's dive into their story. I'm Sandeep Jethwani, your host and the co-founder of Deserve.
Manjushree, the fact that it is one of India's largest packaging businesses, I've discovered when I met you guys in person for the first time. What was Manjushree about? What was the kind of products that you guys were manufacturing at one time?
And when we moved from Assam to Bangalore, so a little bit about Assam, we started the entire operation, or my father started an umbrella manufacturing business. Assam used to get a lot of rainfall, and it was just natural to sort of have an umbrella business.
Yeah.
That did well, and soon it sort of transformed to a packaging company. And the demand for packaging was very high because you have all the organized players in Calcutta, and there was no one in Guwahati to supply the local tea gardens with packaging. So that's when we realized the sort of need for that. And he started this plastic packaging in sometime in early 80s, and it went very well. We did well. We navigated the entire license Raj to get all the machines in and raw material in. And 94, I think, is when we decided to go public. In fact,
and this time you were still in Assam,
we were still in Assam.
Okay.
Yeah.
But you have vivid memories of the time when the family relocated. What was the business like in the early to mid 90s? And Rajat, by this time you had some of these larger players working with Manjushree for their production. Which were some of these marquee players that you guys were supplying to? And what was the scale of the business around the time that you decided to go public?
So not many people know, but to put up the business in Bangalore, we had the IPO from Guwahati itself. So it was our first IPO of 4 crore rupees in 1994.
Interesting.
And that was the time Harshad Mehta hit.
Yeah.
So it was a very, very tough IPO for us. We just about managed to sail through and get it subscribed through friends, family, and so on. And I would say that for the first couple of years, we didn't have any large marquee names because at that time, Pearl PET or Pearl Polymers was really perhaps the only one in India who had the monopoly.
It was synonymous with PET bottles, Pearl, I remember.
Correct.
That.
So nobody used to say a PET bottle. It was a Pearl PET jar.
Yeah, that's right.
And at that time, the plastic bottle industry was a very big one for mineral water. Bisleri had just stepped in, and there were plenty of local production. So I remember 1998, we did a turnover of 2 crore rupees on the business overall. So we also had a small talk in-house that the whole business or the machines and everything together has cost us 6 crore rupees, and we have done a business of 2 crore rupees. How will we ever sustain?
Sure. Yeah.
But I think things looked better. We had good capacity utilization by 2001, 2002, and the business did well. A very interesting thing happened on the year that I joined, 2003, the business. So my father had promised the whole sales team that I will take you to Nepal if we can do 6 crores of business.
Sure.
So 6.5 crores was the turnover that year, and we all go to Nepal for this, marketing meet.
Yeah.
and we had a new person there who was well educated from an interesting institute, and he was our marketing manager. So we said, Ajay, why don't you address everybody and give us the vision for the future? So he said some English, blah, blah, blah. And he said, so next year's target is 12 crores. So everybody was wondering, we are 6 crores. How can we be 12 crores next year?
Sure.
And I think the Josh of Nepal was such that everybody said, yes, we will do it. Now, long story short, that year was 13.5 crores next year.
Sure.
And it just went on and grew from there on in.
So I remember, even interacting with Vimalji and Surendraji, is that their curiosity and openness in terms of newer ideas was very high. Like typically, there's a natural resistance when a new idea comes. But in their case, they were always curious. They ask a second round, third round of questions. And I think that's somewhere where their openness, even on the business side, reflects, right?
It's true because, for example, in 2008, we had our follow-on public offer.
Sure.
At that time, Coca-Cola and Pepsi were just at their tipping point, and they were exploding in terms of market acceptability. They wanted new vendors and the machines to produce preforms, which was their primary raw material in terms of packaging, was a very, very expensive machine. Not many in India had, and I think that risk-taking ability was also high, and we said, does not matter. And we went and bought a very high-end machine with a very high cavitation, which was unheard of in the Indian market. Even the existing players did not have that much of cavitation on the molds.
Sure.
We went ahead and we filed an FPO. Again, on that FPO front, Reliance Power came in a week before our
This was
FPO.
the peak of the 2007-8 bull run.
Correct. 100%. So I remember very vividly, 8th February was our FPO. And the market had completely run dry of money. There was no money left. We were a small FPO of about 54 odd crores, 36.
Wow. And that was not getting filled up.
That was not getting filled up.
Wow.
So again, we reached into friends, relatives, everybody who we could phone up, ki, come on, yaar, we will make sure we earn money for you.
The banks were very supportive.
So banks applied into the
Yes.
issue. Wow.
Yeah, one of them did, but it was primarily the friends, relatives, and people who kind of trusted in us, who put in this money.
Yeah.
And that's when we got started on to, I would say, the next phase of growth for Manjushree.
And some of this then led into a marquee private equity investor like Kedaara coming in. A listed company thinking about going private all over again, and God knows it's really hard to take a company private in India, right?
Absolutely.
So what was the thought process? Why did you decide to flip the switch? Because normally people don't take a listed company private.
I think 2011-12 we realized that, look, everything is going great. We have the right revenue, we have the right customer mix and everything, but I mean, 0 to 1 or the 1 to 5 journey was covered. How did the 5 to 50? How do we take this journey from 5 to 50?
Yeah. And
that's when we realized, look, private equity, we don't need the capital. Fortunately, it was a profit-making company with very, very impressive EBITDA of 20+%. Banks were supportive. Our expansion projects were getting funded. There wasn't an issue. But I think what private equity players do best is to add gasoline to the fire. Packaging is a company or an industry where it isn't the most, at least in those times, wasn't the most preferred or a very highly marketable security company, right?
It's not sexy
IT,
as they say.
And we hardly had any volumes. And then the compliances of actually running a listed company at those times was really, really high. And with Kedaara, it was an outstanding partnership. I keep telling this, and I probably might have repeated this in another podcast, but if there was ever a book written on how PE and family businesses work together, ours will be the #1 chapter on that.
That's just very hard to take a company private. How was that experience of delisting for Manjushree?
I think one of the most important reasons why we were able to pull this off was the attractiveness that we gave to the shareholders.
Yeah.
Say suppose if somebody invested with us in 94 in our IPO, that was a 10 rupee share, and we offered this for buyback in 2014 at 456 rupees.
Wow.
So that's 45x of investment in about 20 years time.
Yeah.
Again, on the FPO, this was a 40 rupee share or something like that.
2008.
2008. And in 2014, 456 rupees. So that is a 10x return that we offered as a buyback. So I think that was one of the toppest attractions for people to give back their shares, because I think we gave them more than the fair share of their money.
Returns in that
and
time.
Returns.
Yeah.
We got many letters and emails saying that, look, I bought a house and, I got my daughter married and a lot of life changing.
That's very satisfying.
Yeah.
Like that's a venture capital exit, right? No, it's fantastic, and I'm sure you would have impacted so many lives in that journey. The next phase, which is when Kedaara invested, what was the kind of quantum that they put in both primary and secondary, and how much did they exit out at? So what was the return that you now delivered to Kedaara in phase 2?
Well, I don't know how much of it is public information, but I think Kedaara had a very, very good outcome, untypical of a regular PE investment.
We delisted before Kedaara invested.
Sure.
So practically it was an entire secondary sale only.
Okay.
So once we got our 96% of the company,
Sure.
then we sold to Kedaara at exactly the same price as what we bought back. And then we sold 40% to Kedaara.
And how was the process of then getting in Advent, and what was the involvement of the family in the third phase?
Yeah, I think what happened is when Kedaara exited to Advent, the family also sold further 40%. So 80% of these stakes were with Advent, and there was an arrangement to buy back the balance 20% at a certain period of time and everything else. 4 of us from the family were so immersed in the operations, sales, and marketing of such a large business. So we had to be fair to the business, and obviously when we knew that there is an exit trajectory already planned out, we had to appoint CXOs.
To replace 4 of us, they had to appoint the CXOs, and that's what they did. And we transitioned very, very smoothly, very quickly from being CXOs of our respective fields to then only shareholders of the remaining 15-16%, because 2-3% is still with the public and continues to remain so even till today.
Is it? Okay.
Some people perhaps think the 1600 or something will become 6000 perhaps.
I'm sure it will.
Yeah.
But the interesting thing is for you all to imagine life post the exit, right? Because when you're getting into these discussions with Advent, there is an end date being put to your involvement. So how were those discussions within the family that what will we do after this?
Even today, we all go to office at 9. We can very well go at 11, come back at 3, 4. But no, we put in the whole days of effort to go at 9, come back after office hours and give that 8 hours to our businesses, our investments, and everything else that we own.
That's interesting. And, while the numbers may not be public, let's just say that this was one of the biggest exits in packaging at that time, running into hundreds of crores, if I can say that. Then this was this juncture of creating this formal family office, where now you wanted to put structure around how this capital will be managed.
We introduced it in about late 2016, and we said, whatever we got from Kedaara times, we will try and manage it as collectively as an office, and they will put it out there into the capital markets. So we built out an IPS. I think one of the
IPS is an investment policy statement guiding the family office.
That's right, yes.
And what are the components of this policy document? I know we have discussed it in the past, but how does this look like? How is it followed in practice?
What we do is we've listed out the various components of the market, and we try and stick to certain percentages in which we will invest into a particular asset class.
Okay.
The IPS then naturally transitions into the four-quadrant philosophy that we follow. So we have investment into the public equity and the debt market.
Sure.
That is something that we don't actively manage.
Yeah.
We leave the management to professionals, wealth managers, and all we do is evaluate it as a business to see whether it is, working profitably or not.
Sure.
Over the years, I think we built up a sizable real estate portfolio as well. It's not that big, but it is fair to be called a small business for us.
Sure.
We have close to 1 million square foot that we rent out and to various companies. And
so this is commercial or office spaces, or is it like warehousing?
No, it's purely commercial and practically all warehousing.
Okay.
So these are large spaces which we give out to companies, and then they could use it for manufacturing or warehousing. And that's so practically leasing to large corporates. So that is
the second
part
quadrant.
of the second quadrant. The third quadrant comes back to our primary philosophy that we are not here to while away our time and just not do anything and perhaps retire at 40. That we would like to own and operate 5 different profitable businesses by 2030. Even after our exit from Manjushree Technopack, we owned and operated a business in COVID, which was on physical health and mental well-being called Reset Wellness. And we sold that to Cult Fit already. So
did that have like an arm in Bombay? I remember in Bandra there was this.
That's right. So they were our partners, and we were their partners for the Bangalore branch, so you say. And we sold it together to Cult.
And why did you sell it? Like, why? What was the decision? Why reason to sell it early on?
It was something that did not sync with our philosophy, number one. And number two, I think Cult was looking and we were looking. So it was a natural fit. And I think the value was good. So.
And then there is this alternative asset pool, which is also there, which is sort of like the private equity investing arm of at Capital A, right? And that sort of rounds off the 4 things that you put together. How was that process of setting up Capital A as a separate vehicle, Ankit?
I think what happens is when you're investing anyway as a part of the family office, it can certain amount of times it can become unstructured, and that's when we recruited a full-fledged team and started to develop thesis largely around climate, technology, deep tech, and of course fintech.
And how much of this fund is your own capital versus potentially external capital at some point?
Tomorrow, if I have to go and start a manufacturing business, I know the banks will just fund us at face value. But as a fund manager, if I go and raise capital from LPs, there isn't any track record existing except for the operating bit. And that's what we did. We were very clear. There was no hanky-panky at all. That first fund, 250 crores, it'll be a balance sheet investment. And we will continue to deploy it in a VC style theme-driven investments. So we've done about 25 investments from that, and that's entirely proprietary in nature. And as we speak, we are just getting ready to file our papers with SEBI to raise an external fund to double of that size tomorrow.
Interesting. So you'll take on the responsibility of managing other people's money now. Ankit, in these kind of situations, when there are a lot of options before you, there are times when there might be certain differences of opinion in terms of the direction that needs to be taken.
All the time.
That's good to know. And then the follow-up to that is that how do you address those differences of opinion?
I think the and then we probably have this fabric of hum saath saath hai, despite our differences, both on professional and personal front. We have from the very beginning lived in a joint family. We have grown up together. We know each other so well that despite our differences, we still can't be without each other, both at home and in the office. And I think that works very beautifully.
I think we've brought about a very, very clear mandate that number one, the vision of Manjushree is prime. It's above all our individual vision, our collective vision for what the family should be and what name and fame the family should have is prime. And hence we all subscribe to that vision first.
You know, when all this capital comes in, Rajat, there's potentially a discussion that will lifestyle really change? Will I spend money differently? Will I reward myself with a more expensive car or I don't know, private jet or something? So how was that thought process playing out when this capital hit the bank?
So if you ask me, I would give a lot of thanks to my upbringing, to my parents and to my family. And I'm sure Ankit does the same, that we've managed to live sane with this insane amount of wealth. We had good cars from many years and we never felt the need to move from a Mercedes to a Rolls Royce only because now we have a lot of money. And all of it has also been, I would say, the women in our family have been very, very instrumental in keeping us all stitched together.
I love the insight here that the emotional attachment is to human beings and not to capital assets. You know, honestly, I think I've learned a lot in this journey of working with you guys and talking today. I think there's a lot for all of us to learn from your journeys. Thank you, Ankit and Rajat, for doing this. It's been a long time coming and I really enjoyed this one.
Thank you for having us.
Thank you very much for having us too.